Ladies and gentlemen, distinguished guests, it's a huge honor for me to be here for my third year, and His Excellency Sadiq and Khalid Sail, you know how much my admiration for you grows each year, but seeing this vision come true, and I have been to the World Economic Forum 12 years in a row, the quality of content, the quality of the delegates, the collaboration, the mood, the atmosphere is a great testament to you all. So many congratulations, really fantastic. They are my friends, and they know that I have many broken bones from being a rugby player. They know that I've spent 20 years working with banks. They said, what can we do that makes it even harder for Al on stage? And so they gave me this panel. All the thought leaders that you've heard from today, genuinely some of the most evangelical people in the space around the world. And I think they've all done a fantastic job. They don't really need much introduction, but if we can have Inma and Brett, my dear friend Anthony, please welcome them. So this is either a job to be a conductor of a very talented orchestra, or it's the opportunity to perhaps try and bring the pace down just for a few minutes. It's getting towards the end of the day, and I watched all of you speak with huge energy and huge enthusiasm, but I will take this moment to say, I remember the late 90s before Y2K, and I remember everyone saying, as we turn to the millennium, planes will fall from the sky, banks will shut down, technology goes wrong, the things that we're most afraid of can be easily projected. I'm not suggesting for 1 second that anyone here is trying to sell consulting services on the back of fear or anything like that. But I'd like to get a bit practical, We've heard today about disruption, we've heard about some moonshots, we've heard about M-Pesa, we've heard about Alibaba, Alipay, but I think you then look below the surface of these transformational projects and you then see that China UnionPay still did $17 trillion of payment transactions last year, owned by the banks in China. You look at M-Pesa below the surface and you realize that Standard Chartered Bank is playing a role, as is Safaricom, as is PayNet and Interserve. So we just heard at the end of that last panel, I thought Dan made a great point about fusion. Can we get practical for a second? You've given lots of advice of what's coming. What would you do if you were running a financial institution today in this space? Inma.
Well, if I was running it, it will be about analyzing customer data. What challenger banks, what innovative companies in the financial services have demonstrated is that if you begin to analyze data, looking for insights, your business models change and improve, and you finally discover exactly what products and services you need to be selling to the world, whether it's people or other partner companies. The problem that most companies have is either A, they do not have data or do not know what data they should grab and start analyzing, or they have such an influx of data that is sitting there unstructured in a multitude of platforms, never touched, never dealt with, that they themselves don't know exactly where to begin. So the name of the game would be, how can we zero in into a part of the market where we carve our attribute? Because attributes are the best elements of competitive advantages. Attributes are a combination of things you deploy because they're part of your strategy, but then in circumstances where nobody else can replicate your context. Mm-hmm. So for example, if you operate in a market of 300 million people, your attribute is your geography. You could be doing exactly the same thing in a smaller place like Switzerland, but then you cannot build an attribute there. So it's about the realization of where are your attributes and therefore what specifically you're going to be building that catapults your competitive advantage.
Okay, so I love that answer. So be good at what you do, find out what your 9 out of 10 is if you're a risk manager and you know how to manage risk, but without data you're dead, without clean data, without being able to assess data. Okay, so I buy into that and then I look again at the stats and I say, in the world today there's over 100 financial institutions with over $25 billion of revenue. in cumulatively employing over 100 million people around the world. They know how to access data. They have old systems, but they have suppliers, they have technology and all the rest of it. So, Brent, if I can come to you, and you've talked about this very eloquently for a long time, you're running an incumbent bank in a reasonable sized market, and you've got suppliers, you've got enablers, you've got fintechs. Are you thinking it's only a matter of time, or are you thinking, no, I love this opportunity and I'm going to reinvent?
I think you have to start with looking at the fundamentals of where industry generally is going. You know, the top performing companies on the stock markets are technology players, and that's because their multiples are much, much higher. So while banks generate somewhere between 50 to 70,000 per employee in net earnings, the Googles, Apples of the world are doing $500,000, you know, $750 million, 750,000, 500 to 750,000 per employee. So the economics are fundamentally different when you're dealing with a tech company versus what is a traditional bank. And that's really where the way we've thought about distribution, the way we've thought about growth, the scale of brands in the new world, that's the fundamental shift, you know. So you've got to start with a leadership, technically competent, and focused on reinventing the business of the bank. I think the first thing you've got to do, I say, is stop hiring bankers.
Yeah.
Okay, we're going to come back
You
to...
haven't heard that before?
You're not allowed to clap at that, Sahil. That's not fair.
But you can hire Anthony, because he's pretty good. He's done 3 banks, apparently.
Well,
I've got to disagree with him. Even if I agreed with him, I would want to disagree with him. But I want to start by disagreeing with you, because you said
how can you
imagine
disagree with the question?
Yeah, you said imagine if you were running a financial institution. Well, I think I am. So I'll start at that point.
Yeah, that's a good point.
Yeah.
I agree with
He
you on
insulted
that.
me before you did. That's
Yeah.
He's
unusual.
missed out the word incumbent, but that's fine.
Yeah.
Carry on.
That's it. So far be it from me to be an advocate for existing bankers. But I think we are, if you pardon the pun, we are comparing apples with pears here.
Yep.
I think the point made originally is absolutely correct, which is why is Apple, Facebook, Google, Amazon so valuable, more valuable than the biggest banks? And the answer is because of the data that they hold. And they monetize that data. The data belongs to you and me as customers, but we don't get any of the value for that. They are very, very good at monetizing that data, which banks are not good at doing. But what banks are good at is managing risk. They are in the business of risk management. And ultimately, and I think a lot of people forget this, banks take in deposits and they make loans from those deposits. Those deposits belong to consumers. They belong to the people in this room. They belong to the average man and woman on the street. And we have a fiscal responsibility to look after those deposits, to lend responsibly. And I don't think that's recognized. And of course, the regulator recognizes this and makes us hold a certain amount of capital against those loans. And to the question, which is always asked, why aren't Apple and Google et al. Going into banking? I don't think they like this idea of risk-weighted capital. And why would they, when they can take away little bits of it, the transaction stuff, which is incredibly profitable and requires little by way of capital to underpin it?
And
Okay.
Facebook's really good at managing risk.
So, and again, very important, because I think what you've got here is people that really understand the space deeply. But I also want to look back at history. We've done a lot of future gazing. And let's take one of our partners here today, MasterCard. Okay, absolutely fantastic business. I would say the combined market caps of MasterCard and Visa, both born out of the banks. Yes, it took a while, but we'll come on to acceleration in a second. So over $500 billion of market cap, not particularly many employees, about 25,000 combined across those two businesses. Beautiful annuity revenue streams carved within the banking industry. Now, before 2008, the banks didn't need to move any quicker, right? We know what happened with GFC. We know what regulation is pushing the banks to do new things, but they were the creators of national debit schemes, Jetco in Hong Kong, MasterCard, Visa, China Union Pay, the list goes on and on. We've just seen First Data and
Subprime
Fiserv.
CDOs, yeah.
So we've seen First Data and Fiserv come together for a combined market cap of 50 billion. So banks have, through teaming and scheming, defended their industry before. Retailers couldn't do that. So what's to say, and it may be a cryptocurrency play, there might be a scheme for cryptocurrency. Why can't banks do that again?
No, I'm actually quite, despite all the talks we talk about disruption, I actually believe the banks have a future in the fintech world, but it really depends on the banks, and especially the factor we're seeing that makes the banks that are succeeding and the ones that are not is genuinely leadership. I mean, I was actually very impressed this morning by the talk you were giving, not only talking about the future as a leadership of an organization, really talking about where the vision is and how the industry is changing. I mean, talk about the container analogy to where the vision is, gives actually now everybody across the organization the right to actually think and accept disruption. One of the issues we've seen across financial institutions is unless you have senior leadership buy-in, it doesn't work.
Absolutely.
That's one of the problems we've had with a lot of innovation teams the last 2-3 years. Many of them opened, many of them are closing, by the way. Why? Because often they were seen as PR stints. Everybody had a nice innovation lab, it looked good when you had visitors, it's good for CEO speeches, but actually when you had the senior leadership, like we had this morning, like we had yesterday, talks and empowers people that actually you have the right to think in a disruptive way, that's where actually we see impact. For example, there's one bank in Asia, obviously I won't name it, where the CEO gave a bit like what Sal gave this morning, a talk to his teams and said, you do not work at a bank anymore, you work at a tech firm. If you don't like it, the door is there and you can leave. But those who want to stay and actually want to go on with this journey, this is actually a very exciting journey. And I think that's what the opportunity the banks have to leverage what they have.
Would it also, to continue that point, perhaps, Brett, come back to you for a second, is the world dividing itself into the disruptors and the enablers? So when we look at GAFA on the West Coast and we see these companies saying, I'm just going to use your rails and get consumer permissions under GDPR and all the rest of it. But isn't it fair to say that for every one of those B2C disruptors, there's many B2B2C enablers that want to partner with these banks?
Yeah.
Well, I think what you're finding is that there are some breakout fintechs that are on path to become unicorns or already have done that. Tens of thousands of others that will never get to that stage. And so part of the way that incumbents can accelerate is by working with fintechs, because fintechs can mobilize capital much faster and much more efficiently than incumbents. I mean, for Movin, when we started licensing our tech to banks, apart from doing our direct-to-consumer model in the US, we approached a number of banks, and some banks would be like, show us all your tech and show us the APIs, let us play with it, and then oh no, we're going to build it ourselves, right? And then they would go and spend $30 million and take 2 years to build something we could have delivered for, a tenth of that price in, a fifth of the time. And I don't get that, right? So that's where the opportunity is. Fintechs need revenue, incumbents need speed. And that's the marriage between fintechs and incumbents.
So Inma, let me come back to you and on a comment that we just heard a minute ago about return on equity and value per employee and these sorts of things. So, and my favorite quote by Warren Buffett, if past history was all there was to success, librarians would all be billionaires. Yeah. Aren't we just talking about a shift in the business model? And isn't it fair to say, in a self-fulfilling prophecy way, banks have currently said it's about deposit on file, or it's about size of book, which for many banks at the moment, they're valued at under 1 times book. But isn't it fair to say that banks do have loads of transactional revenue streams? Isn't it fair to say they have a huge share of wallet if they have a merchant acquiring business, if they have consumers that are spending on their debit card? Isn't there an argument to say that banks just need to reposition what it is and what they do financially?
I think the name of the game, if you look at the NASDAQ and the market's winners, is twofold. One is go against the grain. For example, nobody would have imagined 5 years ago that Microsoft, the big seller of software to the world, was going to start sponsoring the Linux Association, building the largest repository of open source code on GitHub, and eventually purchase the largest repository in the world of code called GitHub, okay? That is going against their fundamental business, which is selling software at a price. What if banking was not about money, about customers that deposit money in accounts? Because this is exactly what the challenging banks did. They went for a segment of the population, millennials, that have zero savings, make very little money because they're not enthralled by a career progression in a corporation, and yet they built a bank for them because it was not about money, it was about their data. And why that data is important? Because you ask any FMCG in the world, what is it that they know about millennials, and they tell you nothing. So it's literally ripping off the business model and building something entirely against probably the core of the business.
So we didn't dress rehearse that. Absolutely fantastic answer. Anthony, you talked in your brilliant speech earlier, and you are a genuine hero in the industry to the people that want to do neobanks. You've done it a number of times before, you're doing it again. You said yourself, put profits to one side for a second, put deposits on, let's think about the customer. So who's to say that the bank of the future won't be a transaction engine? It won't just be a set of rails. Other people through open APIs are providing all sorts of services on your supermarket shelves to your customers. You don't have any banking services.
So I think it came from Mr. Salwari's point this morning of the 4 I's. I think imagination is the most important one. The reason people start businesses is because they've got little money, they want to disrupt a big business. What's in it for the big businesses to disrupt themselves? Generally, there is no burning platform. You look around the big banks, their return on capital varies, but they're doing okay. What I think you do see occasionally is visionaries like Bank ABC, like BBVA. I remember being incredibly impressed by the chairman of BBVA 10 years ago, when as a gentleman in his 70s, he said, the future of BBVA is digital. We will not do anything that is not digital. Now, BBVA was not a burning platform. Yeah. It was a very, very successful bank, great returns on equity. Bank ABC is a very successful bank, no burning platform. There is no monopoly on visionaries coming from startups. I think you can look at the big banks and divide them into those who go, things are okay, we'll just keep going as we're doing. And others, the BBVAs of this world, the Bank ABCs of this world, will go, yeah, but the world is changing. To your point about history, I think it was Thomas Santonaya in his book, The Life of Reason, said, those who refuse to learn from the mistakes of history are condemned to repeat them. And a lot of banks are just repeating those same old mistakes.
Absolutely.
The visionary ones, the ABCs, the BBVAs, I'd like to think the 86-400s, the Movens of this world, are saying things have to change.
Yeah, so I think about trust and the business of trust. And what's the value of trust? You've talked about reinventing your business model. And we have the governor, His Excellency, the governor of the Central Bank here, who I think has been mentioned a number of times today. We've seen this in the UK, but I think you're already leapfrogging some of our thinking around open banking and standards, which is fantastic. This has to be a regulated industry. We're talking about people's money. It's not Crazy Frog ringtones. It's not Java games. We saw yesterday Google have an issue where they acquired a company called Nest. Nest has gone into hundreds of millions of homes around the world, and there's a microphone in it which wasn't disclosed. Wasn't disclosed, and they said, we didn't think you'd mind, and you have to give us permission to switch it on. Now, one might argue, well, that won't even touch the surface. Google will just keep growing and growing, but I think it comes fundamentally down to who's protecting society in this. Yeah. Do you have any comments on that, Henri?
No, that's actually a very good point. One thing, as many of you know, I teach FinTech at university, and every year I ask my students who they trust more with their money. Would it be a big bank like HSBC or rather a technology firm? And I can tell these are like they're in their early 20s. Every year, the majority of the students would say they trust as much, if not more, a technology firm than a bank. And I saw it change this year with all the incidents we saw with Facebook in front of the Senate, what happened overnight with the microphone with Nest. Actually, this may be the opportunity for the bank when it comes to trust and really give the element. And I'll give you one very simple example in crypto. When you read the vision behind Satoshi Nakamoto and Bitcoin, the first phrase of that white paper that came out on the October 31st, 2008, was that we should be able to conduct transactions without a trusted intermediary. And the irony is now, even in the crypto space that was built to avoid these intermediaries, The industry and everybody wants these trusted intermediaries. I mean, think about custody. One of the biggest issues we have right now in the crypto space, it sounds stupid, it's custodians. Technically, you don't need it. That's a whole construct of Bitcoin. But why? Because people still, even though technology is there, still want these trusted intermediaries to act as a custodians, which is a bit counterlogical, but because a lot of these new innovations have not established a trust. And what happened overnight, it does not help at all on this.
So that's, of course, all well and good until the trustee dies and takes the security
The
codes
crypto
with
private
it.
key.
Yeah,
Oh, yeah,
or-
I mean,
but all of the
we've seen happen.
exchanges that offer custodian services went bust or were hacked.
Yeah.
This is why if you now buy Bitcoins, you better print the code and put it in a folder at home.
Yeah, but on that point, right? So on exchange, I mean, let me put it this way. If today you're a hacker and you're not targeting crypto exchanges, you're an idiot. Frankly, these exchanges have a lot of assets that are there to be hacked. The good news is most, I can tell, top 10, 12 exchanges now around the world.
That was not a recommendation.
No,
by
I know,
the
of
way,
course, so
everybody.
not to hackers in the room. That's not the
Not a
recommendation.
recommendation.
He's
But-
recruiting a team. actually.
Yes, this is what he does at night.
But what I mean is actually the top exchanges right now, they're getting all these SOC 1, SOC 2 certifications. I mean, they're becoming world class. The problem is you always have these bad apples. Like what happened in Canada, basically for those who don't know, a couple of weeks ago, you had the CEO of an exchange, a crypto exchange in Canada, 30 years old, died suddenly in India. There's about $150 million in crypto assets that we don't have access to. And frankly, that could have been very easily avoided. I mean, you know, there's a lot of, so we work with a lot of exchanges. This could be easily fixed in a week. But unfortunately, it was not. And unfortunately, it's bad apples like these that give the industry a bad name. In the same way that we have in the banking industry, some players that are, let's say, more lax on certain things that give the industry a bad name. And it's the same.
So that's a great point. And Brett, I've got a question for you, but please come
No, I
in
was
on
just
that.
going to say, but trust is changing. And I think trust is no longer a function of the institution as much as it is utility. And I'll explain why. Recently, you've had some very large banks in the UK suffer some outages of their mobile banking, internet banking, infrastructure. Now, if you imagine, say, Lloyd's or someone like that, they go down for a week or 2 weeks. Internet banking's not working, mobile banking's not working, ATM's not working, you can't use the POS. The only way you can get access to your bank account is going to a bank branch and getting physical cash. How long can that situation continue before trust is lost in that institution? In the same way in China, Alipay and Tencent WeChat engendered huge amounts of trust because they were doing Chinese red packets flawlessly, and stuff like that. So utility is trust in the digital economy.
But that's completely fallacious, Brett. That's complete nonsense. Because, so I like Brett, don't get me wrong, but...
Good thing I'm in the middle here,
So
Right, quickly, Anthony, because we're running out of
let
time.
me just unpack that. So internet banking goes down, mobile banking goes down, you can go to a branch and get your money. Where do the branches get their information from? Exactly the same system. If that system goes down, you walk into a branch and they go, hello, I'm Brett King, I'd like $200, and you go, I'm sorry, Mr. King, I can't access your account.
But gents, so you've just, for me, simpleton that I am, you've just described exactly why I believe that although banks will have to change, you will always have banking infrastructure in the center of banking. Because we're going to see, inevitably, we've already started to see it with other firms on the edge, Experian with outages, PayPal. When consumers realize that by putting half their discretionary income into a wallet that's not run by a financial institution, it's not backed by the government scheme of £85,000 of your deposits are covered or $250,000 in the US, and we do have a tech company or a modern day brand company go down and not reimburse you in the same way you're being reimbursed for PPI or any of the other big issues, I think people will then say, as much as I hate to admit it, my bank does look after my money. On that point of trust, and I'm going to come back to you, Brett, to kind of, and then perhaps everyone can make a prediction and perhaps just give a commentary. Nokia began in Finland 130 years ago as a boot manufacturer, made boots. Yeah. And it evolved as a company. And in 2004, when I first heard about what was going on in India, the most trusted brand in India, not the most trusted mobile brand, not the most trusted bank, the most trusted brand in India was Nokia. And Nokia is no more. We know what happened there, and there have been other mobile device manufacturers that have gone the same way. And yet, Galaxy are launching their new phones, the iPhones come along, we heard it about earlier. Aren't we really just saying that some banks are going to make it and others aren't, but banks as we know them today are just going to reinvent like every other industry? Brett, do you want to go?
Well, if you look historically at technology innovation and these changes, you've got swathes of industries who didn't respond. Look at Kodak, look at Blockbuster, Borders, right? So we know there are going to be some casualties in the banking sector. The only way you get to survive this is play by the new set of rules, which is being a technology company.
Inma.
I think that there will be less banks because they will be too late to take the decisions that need to be taken. Kodak went bust, still being the best company developing film in the world. But it's because nobody was buying film anymore, which is who is going to realize of that too late? I believe that there will be certain banks that will not have the vision and the leadership, which is why in NASDAQ, companies like WeWork, and they trade at negative net income. Amazon is positive, but it's just 1.2 billion. The rest goes back into the business. Why? Because they sell leadership and vision.
Got it. Very quickly, I'm going to get in trouble with Aaron. Anthony?
The banks that succeed will be those who put the customer first.
Yeah.
Okay, Henri.
For me, this is the most exciting time in financial history. I think we're going to look back at this period and actually say with all the things going on in fintech, with TechFin, open banking, AI, crypto, this is really going to be a historical point. Some banks will make it, some will not. And actually, I think the most critical element to those who do is going to be leadership of organizations, as we discussed today.
Well said, and distinguished guests, ladies and gentlemen, what a platform for us to be able to have this conversation. What a great group of people, but most importantly, here in Bahrain, and now probably all jetting off to different parts of the world. Great diversity in the room, and I'm so excited that this is becoming the hub for fintech in the region. Thank you all very much. Thank you.